Recent tariff increases are steadily driving up prices on everyday consumer goods across the U.S., affecting everything from clothing and electronics to auto parts and groceries. While individual price hikes, such as a 0.5% rise in apparel and video products, a 0.6% increase in motor vehicle parts, or a 0.7% spike in energy costs, may seem modest, they accumulate, putting significant financial pressure on American households. For example, grocery prices saw their largest increase since August 2022, and specific items like coffee surged nearly 21% over the past year. These rising costs coincide with a weak labor market, leaving many consumers with stagnant wages and less disposable income, which threatens to slow consumer spending, the historical engine of U.S. economic growth. The Federal Reserve now faces a delicate balancing act. Inflation remains near 3% above the Fed's 2% target, but the labor market is showing signs of stagnation, with job creation slowing and unemployment claims rising. The Fed must weigh the risk of stagflation, a combination of high inflation and stagnant growth, against the need to support the economy. Market expectations suggest multiple interest rate cuts over the next year, as policymakers attempt to ease financial pressure on households while managing inflationary forces driven in part by tariffs. Despite the immediate price pressures, economists generally expect tariff-driven inflation to be temporary. However, persistent weakness in the labor market and continued increases in the cost of essential goods could prolong economic strain for middle-class families, forcing them to adjust household budgets and limit spending. The combined effect of higher prices, stagnant wages, and slower consumer demand highlights the real-world impact of tariffs on everyday Americans and underscores the challenges facing policymakers in maintaining economic stability. In conclusion, while tariffs have caused noticeable increases in the cost of key consumer goods, the Federal Reserve is likely to respond with interest rate cuts to support economic growth. Consumers, meanwhile, should prepare for continued price pressures, particularly on essentials like food, gas, and clothing, as the economy navigates this complex intersection of inflation, labor market stagnation, and tariff-induced costs.